Welcome to Two Dudes Talking Rentals. My buddy David Williams and I are jumping on here to talk about our experience and some of the things we're going through, some of the things we've been through being a long-term buy and hold investor.
If I do want to, like you said, recast it, like maybe 30, 60, 90 days in, would that be an option for me to do that if I wanted to dump a bunch of cash on it, like right around the same time that I'm closing on it? So,
Right. No, that makes sense. Um, yeah, that makes perfect sense. I mean, the best part is you've got multiple different options to solve the same problem. Now I think I finally
yeah,
found my right path, but to truly make it, one of the guys I follow a ton is Mike Zuber, one rental at a time.
yeah, yeah.
Love his stuff, and it's so just simplistic to where
Right, exactly, which would
all
represent
day long.
more. Yeah, that would represent more assets that I would have under the books.
Yep.
And we were when we're talking about Kiyosaki, and I absolutely love what Robert and Kim have put together, and I think that they're invaluable in our industry. Yeah, when I was at Squat Up Summit last month, I had run into a guy who was not too far. He was like in the Gaithersburg area, and so I had told him about the meeting, that you
Yeah.
guys have over there, and invited him to come out, and gave him the link to your Who Not How group on
Sure.
Facebook. Yeah. Yeah, he does a bunch of stuff with mobile home parks. So
Okay. I mean, that's the newest trend now.
yeah, I know. I mean, I'm interested in it too. We Nate and I joined Owners Club here at Squad Up. Um, so in the Owners Club group, I mean, obviously there's a lot of people that are talking about RV parks, mobile home parks. So I mean, I basically said, like, I'm not trying to jump on the bandwagon. I've definitely had some interest in this for a long time, but just haven't really known how to like dive into that market specifically.
Right.
But I'm definitely interested in that market. But my concern is there's a lot of hubbub of activity right now of a lot of people tire kicking that idea,
Yes.
right?
I'm in the
So
same boat. Like I like the model. It's I've done bare bones research on it, but it's kind of one of those things where it's like for me right now where I'm at, that's a shiny object. I need to
yeah,
hit I need to hit my freedom number of doors. And I used to
yeah,
think for so long that it was the number of doors, but now a lot of soul searching and kind of deep diving, and it's not just the amount of doors, it's the right doors. So the
right.
last, give or take 6 to 12 months, I've been working on cleaning up my entire portfolio because I've got a lot of what do they call them now, alligator properties that are just freaking eating me
Uh,
alive. So I'm
yeah,
getting rid of them one by one. I've gotten rid of three so far. I've got one to go,
right.
and
Well,
it
that's good.
just looking at my numbers that came through this month, and obviously the month isn't over yet, but what I've been able to collect so far, now that I've gotten rid of three of those, it's like night and day different. I'm like, oh, this is why I do this, you know,
Yeah.
because it's, one
I've
will
got
go
a couple
bad
of
and then
those
it's,
alligator. I've got a couple of those alligator properties also. They're called vacation rental properties. I mean, I love
yeah,
Ocean City, Maryland. Don't get me wrong, but it's hard to make money in Ocean City because the market is so short. Memorial Day to Labor Day, basically.
yeah,
And I was talking to somebody not long ago, and I said, if there's two ways, in my opinion, to make money in Ocean City. One is don't have a mortgage on the property that you own, right? Two is inherit a property that's been in your family for two or three generations in Ocean City that they bought it, for like 70 bucks, 70,000, 125,000, and now you just have kept it in the family over the years.
yeah.
Because if you've got traditional, current valuation death service over there, you can't make enough money to get them to pay for themselves.
Mhm.
So I just put two of our townhomes on the market over there. and I'm hoping to liquidate both of those. I mean, I've got good equity in them between the two of them, and then we have one single family home that's over there. I originally my wife and I talked about putting all three of them on the market,
Mhm.
but I did tell her, I said I said I want to push pause on the house. Let's try to sell the townhomes first because the townhomes are in a condo association, so you got HOA dues,
Yep.
right? And I'm paying like 76, $7,800 a year between the two of them in like condo dues. And I said, because they're in an association like that, and my two units are townhomes. They're two-level townhome units, but there's like four units in a building.
Mhm.
So it's an actual condo association,
Yeah.
right? They're considered condos, even though my particular units are structured like townhomes.
Right.
And I told her, I said, there is a ceiling on how much that those things are going to be worth. They're not going to go past a certain dollar value because it's a multi-family property, right? My single family property that's on a canal with 60 feet of bulkhead, 2 blocks south in a private residential community, I said there's no ceiling on what that valuation is going to look like, 5 or 10 years from now.
Right.
And I really feel like I want to hold that one but sell the other ones
Right.
because that one is the one that's going to appreciate.
Yeah. Now, do you have debt on that one? The single?
We do, but I've contemplated the possibility of taking some of because I'm going to be refinancing that one this year. I've
Mhm.
contemplated the possibility of taking, if we sell both of the townhomes, I think we're going to have somewhere around 400 to 450,000 cash at close, right? Now, not all of that is money I'm making. Some of it is money I'm getting back from down payments or
Right.
rehabs that I've done on them or whatever, right? But cash in hand, I'll have somewhere in 450. So I owe like low 500s on the house. So my thought has been, because I'm looking at refinancing the house this year, I may take, if we sell both of the townhomes, I may take like 200 of that money and put it on the house so that I'm only refinancing like 300.
Right.
And then that would lower my debt service, which would make that, I think, comfortably cash flow. Obviously, you and I both know the argument is, well, but that's 200,000 less that you have to be able to do something with if you tie it up in that property. So,
Yeah. I mean, you're basically untrapping equity from two doors and moving it over to another, but if it
right.
increases your cash flow significantly, then I think it's still a
Yeah.
smart move. Because there again,
Well, my thought,
we're all not playing the same game. Like I'm still
right.
building, growing, and not to say that you're not, but you've hit that 50 door portfolio.
Yeah.
I'm at the I've hit 30 a few times and had to delete a few just to keep struggling back. I'm at like 25 right now.
Right.
And thinking about that, it's like it's not a bad play. It's really not.
Yeah, and I thought also like if I did do that, and let's say I only owe like 300,000 on the house, then there's nothing that says that I can't get like a couple $100,000 line of credit on the house in a second position. Then I have the access to the cash if I get some sort of a JV 6 month opportunity or whatever, I can pull money out, put money
Right.
back in, when I'm done doing that JV deal. So I I'm leaning towards saying that that's what we may do. I don't want to take in like one argument could be, well, just take all of the money and put it on there and then basically own the house for free and clear for the most part.
Right.
I don't want to do it. I think I want to try to split the middle because it lowers the debt service, but it still gives me some cash, you know?
Yeah. Well, I say, and I think that's the best of both worlds. Is you said you were walking with like 450, put 200 in either one term I've heard fairly recently was recasting or a
Yeah.
cash in refi. And
Hmm.
then I think saying the same thing is a rate and term refi, which I
Yeah.
guess would be basically the same as a cash in refi.
Yeah. Well, I've got to refinance it this year anyway because when we bought the house, we got seller financing on the house and we had a 5 year balloon and that's coming due this summer.
Okay.
So I'm working with a couple of lenders right now on just putting my ducks in a row to make sure that obviously I have the refinancing in place. The end of June is when we've got to do that. So maybe I sell property before then, maybe I don't. But one of the things that I want to talk with them about is if I do want to, like you said, recast it, like maybe 30, 60, 90 days in, would that be an option for me to do that if I wanted to dump a bunch of cash on it, like right around the same time that I'm closing on it? So.
Right. No, that makes sense. Um, yeah, that makes perfect sense. I mean, the best part is you've got multiple different options to solve the same problem. And
Yeah,
that's the beauty of being in that position, but also the beauty of
right.
creative structure, creative finance,
Yeah.
creative real estate, whatever you want to call it.
Yeah. And I mean, I'm in a really good equity position on both of those townhomes because we bought in 2020 on both of those during the peak of COVID, so valuations weren't super high at the time and nobody was like buying anything. Everybody was afraid to buy.
Yeah,
So we were taking advantage of that real strong buyer's market during that time period. So I've got flexibility because we have so much equity. If I really want to move it, and somebody comes in with an offer, like I'm not strapped with a high mortgage on them. So
right. Yeah, that
yeah,
definitely helps.
but yeah, I only bring those up because you were mentioning alligator properties.
Yes, I've bounced around between multiple different things, and it's taken me almost 4 years to really wrap my head around. Just stick on what I'm doing. Just stick with the regular long-term rentals, small
Right,
multis, duplex, four or less, singles, duplex, triplex. Stay in that world because I know it like the back of my hand.
right.
Versus, I've tried lending. I was horrible at it. I didn't do enough due diligence. I've tried wholesaling. I was horrible at that. Everyone's like, "Oh, wholesaling is easy. It's this." Wholesaling is hard. It's the lowest barrier of entry,
Yeah,
but to do it at a volume,
yeah,
most people I know that are good at it took 2, 3 years for them to really get good at it.
yeah.
Like I don't have
I mean, I have a
time or
lot of
desire for
respect for
that.
wholesalers because, man, they do a lot of work for the money that they're making, honestly. Because, I
Yeah,
mean, generating leads and getting properties under contract, it's not as easy as what people act like it is.
not even close.
You know,
Yeah, not even
when
close.
when I get something under contract, I get under contract with the intention that I'm buying it.
Yeah, I'm the same way. Um, yeah, I mean, I did all the things that everybody said. 90 days, this consistency. Well, I didn't like it. I mean,
Yeah,
it's not me. It's not,
yeah.
you know, it's just not fun.
Yeah, that's one of the reasons. That's one of the reasons why I've told Nathan to, get plugged in with different mentors within the real estate investor meetup groups because I've told him like, I have like my pigeonhole, that there's this certain stuff that I'm good at and I've gotten good at it and I'm comfortable in it, right? And so I think that's one of the things that has been my takeaway from getting involved with Sub 2 has been I need to challenge myself to try to take myself outside of my real estate comfort zone,
Yep.
right? Because there are other opportunities that exist out there that I might be able to even make more money out of, but I have to be open to the possibility of learning something new and, and getting a little unsteady on my feet
Right.
again, rather than just staying where I know I'm good, because maybe I'm leaving money on the table on a better opportunity. So,
Yeah. Well, and there again, you don't know what you don't know. And
yep,
the only way to learn something new is to kind of go out on that limb, which I started out on that limb, I think, too fast. And now I've kind of pulled back to where it's like, nope, I'm sticking with what I'm good at until I reach the
right,
right amount of doors. And I don't know what that right
yeah,
amount's going to be, but I'm guessing 40 to 50.
yeah,
Um, but until then, once that's done and stable, then I'll start working on something else. I mean, when I joined Sub
yeah,
2 4 years ago, it was like, I know there's there's something coming because I got into real estate at the end of '06 as everything took a nosedive.
Oh
And
yeah, that
then
was an
19,
interesting
20, and
time.
21 as an agent, I'm like, what goes up must come down. I don't know what the
Right.
extent or any of that stuff is. And now hindsight, it's like it was a really good move. But I tried to put it all to where that's everything that's all I'm gonna do. I was quickly humbled and had to reset. Now I think I finally
Yeah.
found my right path. But to truly make it, one of the guys I follow a ton is Mike Zuber, one rental at a time.
Yeah. Yeah.
Love his stuff, and it's so just simplistic to where what is it? Find your buy box, write awful, disrespectful deals. You're gonna have to make a lot of offers to get one. Like, okay, so now I have all the sub two creative finance tools in my belt, and then merging it with that, it's like, okay, slow is fast, fast is smooth, and just I don't need to rush to get
Yep.
there.
Yeah.
Um, I turned down I think a really great deal in Texas the other day. They wanted to close in a week. I needed at least a month. I'm like, just take what you have. I'm not going to hit that deadline,
Right.
but I'm still fixing a lot of the dumpster fires that I've got. I also have like four
Right.
properties under renovation right now.
Hmm.
It's great, and once everything starts cash flowing again, it'll be even greater. But I just
Yep.
depleted a bunch of cash reserves to where it's like, okay, I got to build them back up before I
Yeah.
can tackle another thing.
Yep.
For so long, I just kept, yeah, I'll take that, I'll take that, I'll take that, I'll take that. Oh crap!
Yeah, I can relate to what you're saying about, the renovations and depletion of the cash reserves because we did that this past year. I had several renos that were running at once. I think we had five going at one time at one point last year. And yeah, I mean, cash is not infinite. And so you get to a
No.
point where you're just like, not only are you depleting your cash reserves, but you're also carrying the debt service on that property times, in my case, it was let's five at one
Right.
point in time, when we were at our peak. So you got five mortgages that you're covering with no rental income, plus you're paying all your contractors, plus you're paying all your material fees.
Yeah.
So it adds up quickly,
And
and
quickly.
if yes, I mean,
And
if you
very
sell a
quickly.
house or refinance a house and have a couple $100,000, you can go through that in a matter of months, if you're not careful.
Yeah, it disappears real quick. And it's easy to be like,
Yes.
oh, just put it on my card, put it on my card. And then the bill shows up. I'm like, oh,
Yes. I was going to say
oh,
the card has to get paid eventually.
yeah. It's like that.
And
No, that's great. That's not
sad,
that. Oh, shoot.
sadly, a double-digit interest rate sometimes too.
Yeah. Yeah.
Yeah.
So yeah. And I mean, it's part of the game and I love it. But at the same time, it's like, dude, I got to slow down. I'm gonna go broke trying to get rich if I keep on this pace.
Yeah. Yeah.
So
One of the things that I've, I think I've focused on, over the past 20 years and probably the last 10 to 15 of those specifically has been one of the things that, Kiyosaki mentions in one of his books. I can't remember if it's in Rich Dad, Poor Dad, or if it's in one of the other subsequent books. But he talks about how, Rich Dad basically, taught him to build a business and then to be able to take the cash, the excess cash flows from that business to be able to use that to then invest into real estate, right? And the real estate was kind of like the hobby. The business was the growth engine,
right.
and the cash flows that were coming from the business being diverted in part over to fund the real estate habit, right?
Mhm.
And so I can say, just kind of looking back over the last, 21 years of my life as a real estate investor, I did not probably read that book until about 2002. I think it was written in 97. I read it somewhere in the early 2000s. And, at some point with my IT company, as business continued to grow, especially with their ISP, with the residual subscription revenue, it got to a point where I didn't have to take all of my cash flows and keep reinvesting all of them back into the business because there was a period of time when that's what I was doing, right? But there was a switch that flipped at some point where I could begin to kind of take some of those and move them out. And that's where one of the things that I started doing at that point in time also was getting cash value whole life insurance, right? To take advantage of doing infinite banking. And the infinite banking concept is just as an amazing tool if we learn how to utilize it and implement it early enough in our model, because just like owning property long term, you get this appreciation. It's a slow and steady way to wealth, right?
Yes.
The same to be said for infinite banking concept with whole life, cash value whole life policies,
Mm-hmm.
because it's going to take time for you to build up cash reserves that you can borrow against in those policies. But once you kind of prime the pump on that and you give it 2 or 3 years, uh, you know, I think today, matter of fact, I have it here on my screen. Let me just look at it because I have a spreadsheet and I enter it once a month on the 10th of the month. Most of my whole life policies are with Penn Mutual. So I have a spreadsheet. It's got 12 tabs in it. So I use it for each month of the year. And I'll track my death benefits, my cash available, my loan balances, everything so that I know how much borrowable cash at any given month that I have in those policies. And right now, I have about 285,000 of borrowable cash. I owe like 1.15 million back to my policies in aggregate, right?
Yeah.
Well, what's the great part about that? The great part is I don't ever have to pay that back, right?
Nope.
If I don't pay it back, it just reduces the death benefit at the end of the day. But what does that 1.15 million represent that I owe back to my policies? It represents many, I don't even know how many deals that I've done in real estate by borrowing against my life insurance for down payment funds or for rehab costs or whatever it is. But that 1.1 million represents a lot of real property assets that we have under ownership now that are, appreciating at a steady rate, that are being paid down by those long-term tenant rental income coming through. And so even if I decided that I did want to pay that 1.15 million off at some point, it's not going to be anytime soon because it doesn't need to be, I mean, if I don't pay it, it's going to get paid, by a reduction in my death benefit at the end of the day. But what it's given me the ability to do is, allow it to continue to grow so that it can pass into my estate some point down the road. But in the meantime, as you know, because you have these policies also, I can borrow against it tax free, right? And so I can just continue to recirculate that money, almost like a recirculation pump on a hot water line, where it's just
Yeah.
continually pushing the cold water back to bring the hot water forward. So I'm thankful that I learned about that concept when I did. I mean, my first policies, I think we started, I'm looking here, they were in October of 2016. The sad part is I actually learned about this concept probably 2 or 3 years earlier than that. But the individual that showed this to me, they were still learning the concept themselves. So they did not know enough about really how that concept operated to understand how to explain it to me well enough that I would understand that I could have started 2 or 3 years earlier. I really could have. Because what I could have done is I was concerned about not putting the money back into my business, right? Put it into insurance instead of my business. Well, my business was in a growth phase.
Right.
But what I could have done is I could have put it into the insurance policy and then let it season for about 90 days and then take 70% of it out and put it right back into my business as a loan against the policy. But we didn't collectively, between he and I, we didn't really realize that because neither of us understood the concept well enough. So one of the things that, I try to tell people now is like you need to learn it and you need to make sure that you can get with somebody that understands it well enough to try to figure out how it can work for you sooner rather than later, because get that engine going and priming that pump sooner. Because if I'd had these policies 3 years earlier, what would that have looked like for me,
That 1.5 would be probably be well over two by now.
right, exactly, which
You know,
would
all
represent
day long.
more. Yeah, that would represent more assets that I would have under the books.
Yep.
And we were when we're talking about Kiyosaki, and I absolutely love what Robert and Kim have put together, and I think that they're invaluable in our industry. But
I
one
think
of
they
the
truly
things
are.
that he had, yeah, one of the things that he has said time and time again is, "I will die in debt." Right? That debt is an instrument to wealth. And I think he's actually said it exactly this way in one of his books. He said, "The more debt that I have, the wealthier that I become."
Mhm. It's true.
And then you drag in the Dave Ramsey crowd, and they're like, heads explode.
Polar opposites. But
Yeah.
both of that being said, Kiyosaki works for minds that are like us. Predominantly, it's more Dave Ramsey. Most
Yeah.
people can't handle the debt. Most people can't understand that debt is actually leverage in a cash flowing asset versus just debt. So good debt, bad debt. Good debt pays me money, like Kiyosaki. Bad debt, like Ramsey talks about, is your car payment. You're going out to eat. You're
Yep.
$15
Yeah.
Starbucks every day for a month.
Yeah.
That's
Yeah.
bad debt. So
Hmm.
each one, I think, is right in their own realm, their own aspect, but they're both speaking to two different people.
Yeah. And I think the interesting part is when we talk about that Kiyosaki dives into that and he talks about the good debt and the bad debt. And, he uses the phrase doodads, right? For the little trinkets that people buy that they don't really need to have. But one of the places where Robert really shines over, Dave Ramsey is he's not telling people don't go get the doodads, don't go get the liabilities like the new car or the sea-doos or the boat or whatever. What he says is invest your money into the asset column first and then create cash flow coming from an asset and then let the cash flows from the asset acquire your liability or your doodad at that point. And that's what we like to call in America delayed gratification, right? So if we do, and I think back to a time that I did that like early on, not too long after I read that book for the first time. You know, is this probably back in like 2006, 2008 time period, and I was working for a company, and we were doing. I was in like the mortgage business. We were doing mortgage acceleration software, and it was kind of like a hybrid network marketing company where it was like a broker agent override commission structure. And so I was building a team. I was getting override and commissions, obviously from the team that I was building. And I reached one of their, promotion levels was called branch manager at the time. And it was kind of like, a status to get to that level, right?
Right.
Just with if you were in that company, within that organization, that was somebody, right?
Yeah, makes sense.
And so I decided that I was going to get a new car, new to me, right? Not brand new. I've never been a believer in a new car, but a new to me car. And I've always been a BMW fan. I've owned BMWs for a long time. So, and this was back in 2007. I decided I wanted to get a 740, a newer one. So I bought a 2001 model. It was last year they made that body style. long story short, I like the older body style better. It's a much more Euro looking style rather than a Japanese Honda looking style, right? So I've decided, okay, like I'm now making this much amount in overrides every month from my team's sales. So I'm going to buy this car. I'm not going to pay cash for it. I'm going to buy it. I'm going to put a loan on it. And I've got, several $1,000s a month coming in from this side hustle, basically, that I was doing. So I bought the car and I still have the car to this day. I mean, I've had the car since 2007 and I still take care of it. And the car still drives nice. But how did I get that? I got that through putting in place a cash flowing asset, because a cash flowing asset doesn't have to necessarily be an investment property. It can be anything that generates positive cash flow.
Yeah,
It can be a business. You could buy a
like you just
laundry,
said,
you could
that
buy
your
a
side
car
hustle.
wash. Yep.
Yeah,
And
could be a
so
side
I
hustle. It could
did that
be
exact thing.
stocks, bonds, mutual funds.
Yep.
It doesn't have to be real estate, but it does have
Right.
to be a cash flowing asset.
Yep. And
One
so
of the
I
things
I
that
I use I used that as an example back then when people saw that I had bought that newer, nicer vehicle, and I explained why I did it, right? I said, I have taken the last year and a half and I have built this business model that now is producing me, $6,000 to $8,000 a month in relatively passive cash flow. So now I can justify doing this. I wouldn't have done it in the beginning because I'm personally not, an Amway mentality, fake it till you make it type personality, because when you get into that mentality, it can be an alligator in your life, honestly, because it can begin to eat away at any of those cash reserves that you have if you're trying to live a specific lifestyle in front of other people that really you can't financially support, just because you're trying to recruit them or do whatever to try to, build off of that. It's a house of cards at the end of the day. And I think that we struggle a lot with that in this country nowadays, is that people want to have what their parents have. Like today, like I'm 20 years old and I get married and I want to have the McMansion and the two nice cars and all this different stuff. And at 20 years old, I don't realize that it's taken my parents 20 or 30 years of building a life and building an asset column for them to get to the place where they have the McMansion and the couple of nice cars and stuff.
right. And that's one of the things I try to preach to my kids. My oldest is 21, 18, and then 15. And I'm like, you see me living the life now. My wife and I get to
Right.
travel out of the country quite a bit. We take the kids with us now,
Yep.
but it's taken me 40 years to get here.
Yep.
When I was 20, I wasn't dropping a large chunk of change for seven of us to go out of the
Anything.
country for a week.
Yeah.
That that wasn't even in the realm of anything.
Right.
Um,
Yeah, it's funny. We share a lot of similarities in that regard because I've had similar conversations with my kids, because they'll compare themselves with where they are today in their life and their job that they have and the fact that they're still living under my roof and all these different things or whatever. And they'll compare that with me now, today,
right.
right? With the asset column that I have, with the home that we have, with the cars that we have, with the time flexibility that I have to travel, to go to my vacation rental properties, to do, whatever it may be. And I talked with one of them specifically, actually just earlier this year, probably within the past couple months. And I said, you're in your early 20s. Let me take you back to a time when I was in my early 20s, and let me just tell you a story for a couple minutes. And I just tried to do a side by side comparison to say, this is what my life looked like when I was your age. And I was living in my parents' unfinished basement, working in a, landscaping job for my family business. And, I mean, I was happy. I mean, it was young and dumb and having fun and, doing whatever. I mean, I had a side hustle going, but I mean, I was a college dropout at the time. I just kind of got burnt out of college and decided I wanted to just go work and whatever it was. So the point that I'm making in saying that is that our kids, they do not understand that version of us that even exists, right?
Yep.
And so it's sometimes a challenge to get them to understand. And I think it's our job as parents and mentors of our children, coaches of our children, to get them to understand, like, hey, buddy, we were where you're at,
Yeah.
right? I mean,
I'm
we
not just
weren't
saying,
always
I'm
this
not just
person,
sitting up here saying I understand looking down on you. I've
right?
been in your position and even worse than your current position. So
Yep.
I promise I do get it. You don't see that side of me now, no, but I've
Mm-hmm.
been through it. I've done it. I've had to
Yeah.
tackle this, that, or the other, or,
Yeah.
early entrepreneurship. You get the crap kicked out of you and you figure it out.
Yeah.
Or you don't, and
Yeah.
that's okay. There's plenty of people that are willing to hire.
Yeah.
Some people are built for it, some people aren't.
Yeah.
I think it's 71% of people are, built and wired for a W-2,
Yeah.
and that's okay. There's nothing wrong with that.
Yeah. It's
I'm not
it's
wired that way.
100%.
Yeah, I'm not wired that way, and I wouldn't know
Yeah.
what to do if I had to get a real job.
Yeah.
But, I run circles hour-wise around a lot of people. Some,
Yeah.
thankfully, plenty of times it's productive. Other times it's just busy stuff. But, you know, the,
Well, I think it's interesting when you say about, 71% of the people, that, it's in their wheelhouse that they're going to be a 40-hour a week employee working W-2 somewhere. I've had similar conversations, not just with my kids, but just with other entrepreneurs in general, whether it's in the real estate investor circles or in business networking groups or whatever the case may be. And I try to remind people, like, look, everybody has their place in the food chain, right? And I mean, if we were a world full of business owners, it would be absolute chaos because there would be nobody to actually like work in the businesses to do the work, right? So everybody fits in their place. And I think one of the things that's important for us to remember, and I want to say it was in the book Good to Great, but I don't remember for sure. Um, the concept of being able to give equal amount of respect to an employee, regardless of where they are in the hierarchy within the company, whether it's the CFO, whether it's the janitorial staff, whether it's the gardener, whoever it is, that they all have their place
right,
and that we should have equal respect for all of those jobs, regardless of whether it's the guy driving through the neighborhood once a week, picking up the trash cans and dumping them into the back of the trash truck, which I know nowadays they don't do that anymore. They get the hydraulic grapplers that just dump them in.
yes,
So I'm sure those guys that used to do that job are happy that they don't have to do that job anymore. But you understand my point is that
yeah,
it all is symbiotic, right?
yeah.
And we
I
need
think that's the
all of
best
those
word for
people.
it because without that, nothing moves.
Yeah.
And not to say that, being a garbage man is a bad thing by any stretch. But if you're putting your 40 hours in at your W-2, then you still have another 30, 40 hours to be parent, coach, side hustle, even if it's 5 hours a day or 5 hours a week, it can happen. And going
Yes.
back to the W-2 mindset, I think you and I touched on this, last time we talked, but if I would have just looked back over the last 20 years and bought 1 to 2 houses every year the right way,
Yep.
even traditionally, I would probably be better off than where I'm at today. But
Yeah.
it took
Yeah.
me 20 years in business to figure that out.
Yeah.
So it's like when you try to teach the kids or, a fellow peer, like our mastermind, and it's like, yes, I do. I run 5 businesses and sometimes they run me, but that's me. I enjoy it. I love what I get to do every day, and I still have plenty of time to be with my family. On the
Yeah.
flip side, that W-2 person that's like, oh, well, you have a portfolio already. Yeah, so what? The best time
Yeah.
to
I'm
start
just
was
further
yesterday.
I'm just further ahead in the race than you are. We're running the same
Both.
race.
Right.
I just
I just started
started
earlier.
sooner, right?
Yeah.
Yeah.
You know,
I
and I
mean, and
think
so
Pace said it
like
the best, like nobody can be somebody else.
that's right.
Like you're you, I'm me, Pace is
Yeah.
Pace, and a beginner's a beginner,
Yep.
and everyone's at different levels. And
Yep.
you know, Pace is chasing gosh knows what, but basically trying to be a billionaire. More power to him. I'm a cheerleading for him. I don't want
Right.
that. I want to hit that certain
Yeah, me
number, and
either.
then I want to disappear to a deserted island.
Yeah.
But that's what I want. I
Right.
want to be done. I don't want to keep going forever.
Yeah.
I'm still going to have
Yep.
my hand in it while I'm still breathing. But if I can work 5 hours a week versus 80, I'm going to do that.
Yeah.
And
I agree.
that's what
It's
that's what
interesting
the freedom
you
number is all
it's
about.
yeah, and it's interesting you said just a couple of minutes ago you were talking about if I had just bought a house a year
Mhm.
for the last 20 years and just kept them and just what would that look like today, right? And it's interesting that you mentioned that. And I don't know if it's just my personality because maybe it is because I probably have kind of like this, sentimental, hold on to stuff, pack rat type personality, right? Um, and so I feel kind of it is carried over a little bit into my real estate investing persona in that I kind of joke around with people when I'm like, yeah, some people, like when I was growing up, I used to like to collect garbage pail kids, right? But today I like to collect real estate. I have like a whole monopoly board full of real actual properties, right? And I've joked around about I'd like to probably someday, and I probably should do it sooner rather than later, make my own monopoly board with my own properties on it, just because it would be kind of fun to do, right?
Awesome. I love that.
But but the point that I'm making in that is because of that pack rat, hold on to everything type of personality that I have, I feel it has influenced my investing model to where I have been like this long-term buy and hold person, believing that like my best asset is time, right? That if I just buy something and hold on to it, and I look back now, I mean, in 21 years of acquiring real estate, we've literally sold, other than the house that we built when we moved in 2000, when we first got married, we had a house built and we sold it 4 years later. But other than that house, which was a primary residence, I've only ever sold one other property of like all of my investments. And that was in September of 24. I sold it to the tenant after 6 years of owning it. We made enough money on it. We doubled our money basically. We were able to buy like two and a half more houses from the equity that we walked away with from that acquisition, right? But other than that, I've kept everything. The first house that I bought in November of 2005, I still have it to this day. I navigated through the bloodbath of 2006 to 2008 time period, when we lost all of our equity because unfortunately I bought it conventionally, put 20% down, and then a couple of years later basically waved goodbye to my $65,000 of down payment because of how much the property had dropped in value at that point, right? But I think this is the best part of that story. Those two properties that I bought in November and December of 2005, a year and a half later, they were brutal. And I underscore the word brutal because I did not know how to buy creatively at that time. I had theory,
Oh,
but no application, right? And so I put 20% down with both of those homes. So it was like $130,000 that I put down to acquire those two properties. And less than 2 years later, that $130,000 literally evaporated into thin air in front of my eyes,
yep.
right? And I think back to that time period, and I think that it was a defining moment for me because there were other real estate investors that I knew in that same time period that went through similar situations, and they just dumped their properties. They either did a short sale or they let them go to foreclosure or whatever they did, right? And I didn't. I kept my properties. And it took me about another year after that. So we were about 3 years in at that point. I was able to finally negotiate out of the really bad negative amortization mortgages that I had gotten put into at that time, right? And I literally threatened to just mail the keys back. I just said, I have no equity in these properties at all. I don't live in either one of them. I have a fixed 30-year rate on my house. And so if you guys won't work with me, I've never missed a payment. I've never been late on a payment. And if you guys aren't willing to work to modify these loans, give me the address to where I should mail the keys to because I have no reason to keep them at this point because I'm losing money every month because I'm negatively amortizing, right? So after 3 times of having that conversation over about an 8 month period of time, I finally got them to listen to me. And they did, in fact, modify my loans. So today I still have the properties. Well, when we bought them back then for like the mid threes, and then of course the bottom fell out on the market, here we are now, 21 years later, and each of them is worth about a $500,000 a piece
Yeah.
and I owe about 160 to 170 respectively on both of those properties. But talk about getting your teeth kicked in,
Ooh, yeah.
right? Yeah, very brutal. And so I think that that taught me a very valuable lesson by walking through that situation instead of navigating around it. I learned what I didn't ever want to have to go through again. And so it made me, I honestly feel like it made me become a creative finance investor because I didn't want to ever lose 130 grand again of my own cash that I had, put hard-earned money into. So I felt like there's got to be a way for me to be able to leverage other people's money to do this. So I'm not putting my own money at risk,
Mhm.
right? And
Well,
so
that just
I
goes to
firmly
the,
believe I firmly believe that that situation created in me a propensity to want to make no money down deals work because I didn't want to have the risk anymore.
yeah, and that makes total sense. But it just goes to the cliche saying, call it whatever you want, but it's not about timing the market. It's about your time in the market. And
Yes,
that speaks
100%.
to it right there. Just like you were saying, all your buddies that cash for keys, short sale, foreclosure, they just gave up and you held on to it, had to put some legwork into it.
Yeah.
That's just basic follow up of every real estate investor needs to do.
Yep.
And now you just gained an extra 200K in value. So yeah, you
Yeah.
dipped down really low, probably about 30% low, 10% lower than what you already put into it. So you would have had to write a check to sell it or short sell it.
Yep.
And now you're what, 30, 40% higher.
Yeah.
So,
Compare it to somebody that invests in the stock market.
yeah,
And any stockbroker will tell you that you only lose money if you sell when it's low,
yes,
right? If
simple.
you ride through the storm and you ride it back up again, then you never realize the loss because you just rode through the storm.
Yeah. The best investors are dead people
So,
because they never sell.
yeah, isn't that the truth?
Yeah.
Yeah.
Yeah, I mean,
But it just
that's,
when you said about if you could do something differently to buy the one property a year for 20 years, it just really it resonated with me because that's one of the things that I have done right. And it's one of the things that I now 21 years later and looking back in the rearview mirror of my investing career, I realize that the best decision that I ever made over the last 21 years was not selling anything that I bought, just keeping it and just maintaining it and making it work and putting a proper, putting a tenant in there and cash flowing it, doing incremental remodels here and there to get it to the place where, obviously slowly but surely you brought the home up to current, specifications, as far as like aesthetics and that type of stuff is concerned. But I think that if we, had younger investors, which we do have both of us the opportunity to influence,
Yes.
probably the one piece of advice that we would agree on would be exactly that. Slow and steady wins the race. Buy it and figure out a way to keep it and just keep buying. Even if you're not buying a property a year, even if you're buying a property every 2 or 3 years or whatever that looks like
Yeah.
for each of us individually, if you can manage to just continue to hold on to it rather than chasing the quick dollar of the fix and flip, I think that that's where HGTV and DIY network, you know, they give
Well,
this
they're selling
false
the dream.
narrative.
That's for darn sure. Yeah. They're
Yeah,
selling,
they
chicken
are. They're
training
some. They're.
games.
I mean,
Oh, we just
the
do this and it's done and it's great. And like
yeah,
I've been in the situation and they're not showing a 16th of it, but they're
yeah,
selling TV. They're selling the dream. More power to
yeah,
them. I'm not taking anything away from it.
yeah,
And their remodel
yeah,
work is amazing. And if you can pick up the property for the right price, because
yep,
you can't change what the end sale value is. You can only change what you buy it for. So if you can buy it right, no different than today. Prices are up, rates are up, but if you can find something that cash flows today, when
yeah,
rates, go a little bit lower over the next 5 to 10 years, you refinance and now you're making even more because now you're
exactly.
refinancing less. Your tenant's been doing the pay down, and
Right.
if you can afford it at a 7% and still make money, if that drops down to a
Yeah,
5, now it's a cash cow.
yeah. Well,
And
and if it drops
it's
to a
that delayed
five, I mean, I
gratification.
don't know about you, but I wouldn't just be doing a rate and term refi at that point. I would be doing an actual cash out refi
Oh, for
and
sure.
taking that money out and then going and using it to buy like two, three, four more properties,
Oh, for
you
sure.
know,
Totally.
and
Totally.
and
And my
and
first
I've done that
property.
more than once. One of the reasons
Oh,
why some years I've bought 5 or 6, 7, 8 properties in one year has been because I've done that type of technique where I've consolidated in, done a blanket lean cash out refi. I lowered my payment on 5 properties. I saved myself $4,000 a year in aggregated payments, and I walked away with $225,000 cash at closing because I pulled equity out, and then I springboard that into buying like 3 other properties.
and you didn't pay tax on it because it's debt.
That's right,
So
100%.
can't tax debt.
And
So
because I was able to lower my payments and take the cash out at the same time, I'm not even the one repaying that $250,000. The
tenants
tenant's
are.
rental income repaying that $250,000.
Yeah.
And that's what people don't realize. And this is what the shell game is, and why I say that I will die in debt,
Yes.
because I love debt. It's
Yes.
just understanding how to properly wield it. And I think that that's what we collectively, especially those of us that are veterans in this industry, we need to teach newer investors that are coming into this marketplace to understand how to properly wield that debt and create that cash flow from it so that they can stack the layers of debt on top of one another to be able to build that portfolio. I would not have north of 50 doors today if I was focused on just paying cash for properties.
No,
I
I'm
might
the
have
same way.
6,
Right.
8
Yeah.
maybe.
And the cash flow from that would not be nearly, I'm sure, what your cash flow is today.
Yeah,
But first
yeah.
property I ever bought, or first rental property I ever bought, I still own today. It's sold under a lease with option to buy. It's in its second
Hmm.
year, right? It just started its second year. If it goes through, great. If it doesn't, great. But I've
Yeah, you
refinanced
rinse and
that
repeat.
property. Yeah, I've refinanced that same property 3 times to buy more property over
Yeah,
the last 18, 19 years. So it's like,
right.
and that just falls back to it's not timing, it's time in. because that
Yes.
property I had 90 grand in, including the
Yep.
renovation, is now
Yeah.
worth like 350.
Yeah.
Like
Yep.
you can't buy that.
Yeah.
And
Well, and that's why, one of the things that I have told my kids is, my intention is I'm not going to ever sell my portfolio, right? I want to be able to leave that portfolio of real estate assets to my kids to build a legacy, right?
that's my
And
plan as well.
so, one of the things that I've really tried to instruct them on is don't sell these assets because most of these assets by the time that I pass are probably going to be mortgage free. Maybe
Yeah.
there will be a mortgage on a few of them, whatever it is. Easy enough to consolidate that down because you're talking about global cash flow at that point. But I said, if there's one thing that you guys do, if you don't continue to expand that real estate portfolio, at least retain the portfolio that I have that I'm leaving you with. Because if there's no debt service on that portfolio and all you have to pay for is maintenance and management and repairs type situation,
Yeah.
like there's enough rental income that would be coming in gross at that point with no debt service that like all three of them and their families, they could all basically live off of the income that would come into that trust, and that would still increase in value. They would be able to have additional liquidity to be able to maybe even buy another property or two every year or two, kind of thing. So I
Makes
think that
perfect
these are
sense.
the things that, as we get into the space and we become more successful in our own right, like it's important for us to remind people that there's a bigger picture, right? Now, not for everybody. For some people, it's just
No.
about them. And at the end of their life, there's nobody that they're going to leave it to. And maybe they're going to just leave it to a charity or whatever is going to happen to it. And that's fine. I mean, I can totally respect when that situation occurs. But for people that have an opportunity to shift the tracks financially in their family for generations to come, it dives into which obviously I don't think we want to get into today, but we start
I was
talking
gonna say
about
we'll
how
we'll,
we
we'll save that
structure
one
that.
for the
What are those,
next episode.
what do the trusts look like and how do we structure that stuff,
Yeah,
right?
I think next episode we talk about the trusts and the life insurance. And I'll leave you
Yeah,
with this one tip. Have your trust for anybody watching. David and I have the same type of trust. We'll go into it on the next episode, but I have my trust own all of my life insurance policies,
yep,
and they're also the beneficiary. So
yeah,
now I'm loading them with non-taxed income, and they're growing tax free. And
right,
then there's no distribution because it stays within the trust. So there's no tax across all of it.
yeah,
I'm still fairly new in this endeavor, and I'm what, 3 years in, 2 years in, and now I'm really starting to see the fruits of the labor from it. No different than
yep,
my big life insurance policy. I'm 5 years in, and I only have two more rounds of payments that I have to put in, and it's freaking gold. I know using the life insurance between what it's growing at, what I'm charged, I'm basically paying myself and charging myself 2% interest. If you can't make money with 2% interest, there's something wrong with you, or just this isn't the
yeah.
right field.
Well, and one of the keys in how yours is structured differently than mine, and obviously I'm in the process of restructuring mine now, but you're able to purchase your life insurance with pre-tax dollars. And in my case, because of the way that I'm doing it, I'm still paying tax on the money that I'm putting into my life insurance policies, right? So by restructuring it like you are structured currently to where your trust owns those policies, is definitely the way to go. And, so um, hats
Well,
off to you for doing it correctly.
trial and error.
But
That's all it
my
is.
I started my policies earlier than you did, so there's at least that. The nice
That
part
you got.
is
Yeah,
I
you
can
definitely got me beat on that
transfer.
one.
Yes, I can transfer those policies to the trust where the trust will own them. But I do think about it, if I had known that information years ago,
Oh,
6, 7 years ago, whatever, actually 9, 10 years ago at this point,
yeah.
about how much money that would have saved me in taxes over the last decade if I'd
Oh,
have been able
buddy.
to buy,
Oh,
put all that cash in with pre-tax dollars.
yeah. No, and it's not
We
the
we
it's not the
we
big
pay a
changes, it's
lot
the
of
little ones.
money. We pay a lot of money in life just literally because of lack of financial education. And I think that's the takeaway at the end of our conversation today
Yes.
is um, how much does our illiteracy wind up costing us, right?
Yeah. It's cost me a lot.
Yeah,
But
me
that's
too.
that's how I've been able to learn and learn
Yeah,
quickly is just quick trial and error.
right,
When you try them three and four at a time, I don't recommend that. Try if you're going to trial and error something, try one at a time, not four or five.
right.
It's not. It
At least then you
stings.
know emphatically what doesn't work.
Oh goodness, yeah. I've learned real quick what doesn't work. That's for sure. Um, so, all right. Well, for everybody watching, thank you for tuning in. We will be back with another episode. We're not really sure when because we just decided we were going to jump on and start talking real estate. And between us, we are 41 years into real estate investing, and I'm a second generation realtor and investor myself. So thanks for tuning in, and we'll catch you on the next one.